Welcome to the deep dive. We try to cut through all the noise, the market reports, the forecasts, and really just boil it down to the key things you need to know. And today we're doing a deep dive into the October 2025 energy outlook. We're focusing hard on natural gas and power fundamentals. Yeah, and this isn't just your typical, what's the price doing kind of check-in. We're really looking at, a massive tug-of-war playing out right now. It's this clash between, on one hand, record U.S. supply almost looks complacent, right? And on the other, this really unprecedented wave of new demand, concentrated demand, changing the whole map faster than anyone really saw coming.
That's exactly it. And the core tension, the thing you really need to grasp is this. On paper, the U.S. natural gas system looks, well, comfortable. Production's robust. Storage is looking healthy. Injection rates have been strong this season. But, and this is the key part, those numbers, they're getting misleading fast because you have these huge structural shifts in demand. Think global appetite for U.S. LNG exports. It's just insatiable. And then domestic electrification, specifically these AI data centers, they're completely changing the forward market. We're starting to price in long-term scarcity, even while we're, sitting on what looks like short-term abundance.
Okay, so that's the puzzle we need to unpack for you. Is the U.S. actually swimming in cheap gas right now, feeling secure? Or are we maybe sleepwalking towards a major squeeze, a squeeze that could hit the grid harder and faster than maybe the models are predicting? Let's start with that foundation, the supply side.
Exactly. And the foundation looks solid, which is why the pricing, the volatility is so interesting. Let's start with storage. As of late September, say, week ending the 19th, U.S. working gas storage was sitting at 3,508 DCF, billion cubic feet. That's a pretty healthy number.
3,508 BCF.
Yeah.
Okay, and how does that stack up against, like, historical averages?
Critically, it's 203 BCF, so about 6% above the 5-year average. And when you've got that kind of cushion, the immediate panic tends to fade a bit. Plus, look at the refill season we just had. Injection rates, they've been really impressive, running about, 18% higher than the 5-year average?
Wow, 18% higher? That sounds like a strong argument for, lower prompt prices, especially for November delivery coming up. If those trends keep going, where does that put us end of season?
Well, if those injection rates stay aggressive through October, we could see inventory getting close to 3,956 BCF. That path, it strongly supports that view of comfortable storage heading into winter. And normally that should push down near-term prices.
Right, should.
But here's the thing. The market isn't really buying that short-term comfort anymore, which tells you the real worry is about the balance after this winter, heading into 2026 and beyond.
And it's not just storage, right? The supply side itself, production, has been, phenomenal. We're not just drawing down old gas, we're pulling record amounts out of the ground. U.S. dry nat gas production hit, 108.0 BCF per day back in July. That's basically the highest monthly output we've seen in 5 decades.
Yeah, an astonishing number. And it's not just a blip. Output's been averaging over 107 BCFD all year so far. And it looks like it's going to hold pretty strong, relatively flat, but flat at a very high level going into 2026.
Okay.
But what's interesting kind of beneath those big numbers is a subtle shift in where the gas is actually coming from.
Okay. Tell us about that drilling shift. What's happening there?
Well, we're seeing the money, the rigs moving pretty aggressively towards the big gas basins, think Appalachia, Haynesville. And they're pulling back a bit from the oil plays, where gas is more of a byproduct of drilling for crude.
Right, associated gas.
Exactly. So this suggests the industry is really optimizing for gas volume now. They're responding directly to that huge expected demand, especially for exports. They're putting their capital where they see that long-term structural demand floor rising. Makes sense.
So, okay, we've got high storage, record production. Sounds great on the supply side. But let me play devil's advocate here a bit. If the market's ignoring this, like you said, is this just a giant head fake? Is this high production just kind of masking these huge structural commitments like the LNG build out? Commitments that will just eat up that cushion the second the weather turns really cold, or, if one key pipeline goes down for maintenance?
That is absolutely the right question. Because despite how robust things look, the immediate risks are still very real, and they highlight how tight the margins are actually becoming. You could see really rapid storage draws if we get, say, an unexpectedly cold snap early in the winter, especially up in the Midwest or Northeast. And you mentioned infrastructure. That's huge. Planned maintenance is one thing, but an unplanned outage at a key pipeline or processing hub, that could suddenly cut supply by a couple BCFD easily, cause a sharp price spike. So fundamentally, yes, supply is robust for now. But that for now window, it's shrinking fast because of what's happening on the demand side.
Okay, let's definitely unpack that demand side then.
Yep.
Because this seems to be where the whole market narrative just flips completely on its head. If supply looks so good, why are prices, especially the forward strip for Henry Hub, trending up? It seems the balance is being tipped entirely by these two just massive structural growth factors. Let's start overseas with LNG.
Right. The U.S. is really cementing itself as the world's dominant gas supplier. And the sheer volume moving through our terminals now is, well, it's staggering. Back in August 2025, we saw record exports, 9.33 million metric tons. That translates to roughly 13 DCF per day of gas running through the existing facilities.
13 BCFs a day, just for export.
Just for export. But that's just today. The future is really being built on investment decisions made right now.
And those are the FIDs, right? The final investment decisions. And they've been kind of off the charts this year.
Off the charts is a good way to put it. Huge. And maybe we should clarify what an FID really means for you. When we talk FIDs, we mean these companies have locked everything down. They've got the financing, the regulatory approvals, and crucially, the long-term sales contracts signed. They've committed the tens of billions of dollars needed to actually build these enormous liquefaction plants and export terminals. It's almost irreversible at that point.
Okay. Locked in, basically.
Pretty much. And in 2025, we've seen record FIDs. They've sanctioned 55 million tons per annum MTPA of new liquefaction capacity just this year to date.
55 MTPA. Just put that in context for us.
Well, it's simply a measure of how much super chilled LNG they can produce each year. And 55 million tons. That's the highest annual total ever committed to build in the U.S. ever.
Wow. Okay. So we're not just talking about blueprints or hopes. This is concrete construction timelines we're looking at.
Exactly. And if you connect that investment surge to the bigger picture, well, it translates into roughly a 75% boost in U.S. export capacity by 2030.
75%.
75% increase in our ability to ship gas overseas. That basically guarantees a long-term price floor for domestic gas. We're talking about huge projects, like Venture Global CP2 Phase 1, that's 20 millitipa right there. Others, like Louisiana LNG, adding around 10 millitipa. This long-term, essentially guaranteed outlet to the global market, it ensures a tighter domestic balance for years to come, almost regardless of today's production records.
Okay, that's the global pull. But here's where it gets really structurally fascinating for the U.S. energy market itself, our own power sector. Natural gas already fuels, 40% of U.S. electricity generation? That's about 35.8 BEC this year alone. But that consumption isn't just growing steadily anymore. It seems like it's set to skyrocket because of one huge structural shock: AI and these hyperscale data centers.
That is the structural change that is sending shockwaves through the independent system operators, the ISOs, all across the country right now. The load growth from these hyperscale data centers, it's the single biggest shock to the power system, period. Because the demand is just immense. It's persistent, 24/7, 365, and it's very, very concentrated geographically.
Okay, give us a sense of the scale here. How big is this shock?
Well, the projections we're seeing suggest AI and data centers could add, well, on the low end, maybe 10 gigawatts of new electricity load. But on the high end, it could be a staggering 65 gigawatts by 2029.
65 gigawatts. Just put that in perspective.
65 GW is roughly enough power to run the entire state of Texas during, say, a moderate demand period. It's enormous.
Wow, okay.
And the connection back to natural gas is immediate, right?
Yeah.
Data centers need incredibly reliable power, 247 reliability. Renewables alone, they just can't guarantee that yet.
Not yet.
So all that surging electricity demand, it fuels demand for the most reliable, dispatchable fuel source we have, which is natural gas. This accelerating nonstop load growth is the main reason we expect power sector gas demand to jump by 2.3% just this year alone. That's probably just the beginning.
Okay, so let's try and tie all these threads together: storage, production, LNG, data centers, and connect it back to market pricing. Because the Henry Hub forward strip, it really feels like the perfect thermometer for this whole tension, doesn't it?
It really does. Because despite that comfortable storage cushion we talked about, despite record production, the market is clearly pricing in future tightness. The prompt month, November 2025, is trading around 3.337 per MMB2, million British thermal units. And if you look out further, year over year, the whole strip has trended upward. It's up, 11% month over month, 15% year over year.
So the traders are basically looking past the 3,500 BCF in storage right now.
Exactly.
And they're focusing entirely on that 75% future LNG export capacity jump and this potential 65 GW data center demand bomb.
Precisely. You've got these bearish factors, high production over 107 BCFD, high storage, but they're fighting this multi-front war against overwhelmingly bullish factors. You've got record LNG commitments locked in. You've got exponential power demand growth driven by data centers. And you always have that wild card of winter weather risk. The price trend makes it pretty clear. The bullish factors are winning the long game right now.
So what's the key takeaway for someone trying to navigate this?
Well, the takeaway for you right now seems clear. You should probably favor hedging those winter strips and maybe even looking further out, because the upside potential driven by exports and this domestic load growth, it feels like a strong structural reality. Even if high current production puts a lid on immediate prices sometimes, you're essentially paying a premium now to guarantee your supply in, say, 2027, 2028, because those LNG terminals will be running and those data centers will be plugged in and demanding power.
And that strong clustered gas demand, it translates directly into strained electricity markets, right? Gas is the fuel, but the grid is the delivery system. And it sounds like it's under severe, very localized pressure. We're seeing some really aggressive electricity demand forecasts in key areas.
Extremely aggressive.
Let's look at the grid operators, the ISOs. ERCOT in Texas. They're projecting load growth averaging 11% annually. That's huge.
11%, yeah. And PJM, which covers a massive area from the Mid-Atlantic through parts of the Midwest, they're looking at 4% annually, still very strong.
Right.
And PJM, just as an example, they're now planning for their summer peak load to rise by something like 70,000 megawatts over the next 15 years. This isn't just normal, steady industrial growth we've seen in the past. This accelerated load is almost entirely driven by the clustering of new industry and, most importantly, these data centers.
So it's concentrated.
Highly concentrated. Here's maybe an analogy for you. Imagine you've always just run a few regular appliances in your house. Now suddenly your utility has to figure out how to power 20 high-powered servers running full blast, 247, all drawing power from the same circuit breaker, basically.
Yeah, okay.
The load isn't spread out evenly. It's hitting specific ISOs really hard. PJM, ERCOT, MISO in the Midwest. And this rapid, huge load growth, it's happening way faster than the physical infrastructure, the transmission lines, the transformers can possibly get upgraded or even permitted.
So what does that concentration do to the actual price of power right now in those specific regions?
Well, it means higher prices, almost certainly, and probably more volatility, too. Forward power prices are definitely trending up, maybe 1% to 2% higher week on week, month on month recently. We're seeing PJM Western Hub for December delivery trading around $57 per megawatt hour. MISO Indiana Hub right there with it, about $56.80 for December. And this bullish outlook is primarily driven by that data center demand combining with the rising fuel costs and the natural gas costs we just talked about. Those factors are simply overwhelming any potential downward pressure from, say, adding more renewables right now. The grid stress itself is becoming a primary pricing factor.
Okay, so let's wrap this up. What does this all mean? What's the big takeaway from this October 2025 Energy Outlook Deep Dive?
It really feels like the U.S. energy balance is tightening rapidly and fundamentally. We've got record gas coming out of the ground, yes, but that supply is effectively being soaked up instantly by these two almost historically unprecedented demand forces hitting at the exact same time. You've got the global LNG export boom putting in a really robust price floor, and then you've got this domestic AI data center boom creating exponential, highly clustered peak demand. That's a great summary. And the key drivers for you to remember, the things really shifting the ground beneath our feet. Think about that estimated 75% increase in U.S. LNG export capacity coming by 2030. And remember that potential 10 to 65 gigawatts of new load that data centers might add by 2029. Those are the two huge structural shifts that are basically resetting the energy market equilibrium. They define the risk landscape for the next 5 years, easily.
And that leads us right into our final provocative thought for you to maybe chew on after this. Given that this massive load growth from data centers is so heavily concentrated, just hitting a few key regions like ERCOT, PJM, and MISO really hard, the critical question might not just be about the price of gas anymore, or even the price of electricity. Maybe the most urgent question now is which region's actual physical transmission infrastructure, which grid, is going to break first under the strain of this sudden, aggressive, and incredibly localized new demand. That's the deep dive for today. Thanks for joining us.